Well, a couple of things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. In deflation, it could be even with a very low nominal yield, it can have a much higher real yield in a world where prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse than 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. By the way, the person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, and that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets. In crypto, there's nothing there, but they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange, or you own a lender set. Now that's all imploding. It's kind of a replay of 2008, except instead of, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and Morgan Stanley was hanging by a thread. It's FTX most prominently, but Genesis is kind of considering bankruptcy, etc. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino, put my money on the roulette table, and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, you kind of just referred to it, is there a global liquidity crisis coming? And a liquidity financial crisis is different from a recession. Sometimes you can have one without the other. 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, 65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency, and that was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which, for people not familiar with the Q word, is 1,000 trillion. So you pointed to 65 trillion, and you're right, that's FX, but there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, U.S. was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. They're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, the Shanghai Cooperation Organization, OPEC Plus, China individually, all these countries are the Eurasian European Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. The thing is, people don't understand reserve currency. It's not as if the People's Bank of China has pallets of $100 bills stacked up in the basement. Reserve currency means a currency of denomination of securities. So what China does have are treasury bills and treasury notes. So the key to being a reserve currency is not the currency, it's the bond market. Do you have a large, safe, liquid bond market? And if you do, then people will buy those bonds. What else are they going to do with the money? But that's much harder to replicate. Well, they can't have a currency backed by gold, at least not the Chinese yuan, because the problem is there is no Chinese yuan bond market of any size, number one. Number two, they have no rule of law. I mean, no, I wouldn't trust the Chinese or the Russians for that matter. And the U.S., the problem with the U.S. is that we had a good thing going. I've always said the world will not destroy the dollar. The United States will destroy the dollar through our own policy blunders. And when you freeze the assets of the Central Bank of Russia, I don't want to debate the war in Ukraine, that's a big subject, but when we freeze the assets of the Central Bank in Russia, and you're the Central Bank of Turkey, Saudi Arabia, China, you're like, hey, how do I know that next week the U.S. isn't going to not like something I did? Are they going to freeze my assets? So little by little, yeah, at the margin, you get out of treasury notes, you get out of euros for that matter, and get into gold. So there is this displacement effect going on, and it wouldn't surprise me to see China announce a big bump, maybe 500 tons or more in their gold reserve. I would say they already have it. They just haven't announced it.